this is our second note of 2022. An auspicious day today, if you think about it. I've heard of palindromes and all sorts of new names, but it's effectively 22022022, which probably is not going to something similar like that or unique as that is going to happen in our lifetime again. But an auspicious day, and we're glad to welcome you into the webinar. So yeah, it speaks for itself. This note has struck. It strikes on the 11th of March. It's live. It's available. It's a US dollar income. It's 2.5% per quarter defined return, so 10% per annum. So it's not in the space of some of the notes in terms of the coupon levels that have been delivered perhaps over 2020 and 2021, and we'll go through that as to why. The world is in a really, really interesting space. And I think if we drive onto this next slide, it kind of says it all. You know, I'll let you have a look around the different words, the different descriptors, which are all kind of in a bit of a negative space, if I have to be truthful. And whilst you read through them, I've sort of acronymed it to two things, or two little phrases. The one is, let me just get it. I wrote it down here for a moment a sec. I acronymed it to FUD, FUD. And FUD generally is quite a well-known, it's actually a well-known term in investing, especially marketing. And it's basically an acronym to fear, unease, and doubt. And we'll go into a little bit of that and where all these sort of headwinds going in different directions. The person who put the slide together is obviously quite creative, and I looked at it and I see different stresses, tensions, pulls and pushes, but it's all dynamic, but it's all kind of stretching us. Hence the risk and volatility are pretty large in there. The other one, which I found, another acronym which I found, which actually comes out of the crypto world, the cryptocurrency world, is HODL. Some of you may know it, some of you may be investors in that space, but effectively it's a bit of tongue in cheek, and it's hold on for dear life, because we're in a space now where we really are being buffeted by these headwinds. And, it's a space that I think there's consensus within the slide that the global political and economic environment is going to remain very complicated and very complex in 2022. The pandemic, you can see the pandemic's built in there right across from sort of 7 o'clock downwards up to 1 o'clock on a clock. The pandemic is really sort of easing now, and it's going more into an endemic situation. There will be spikes, there will be flare-ups, but the major developed and emerging markets in the world have got to grips with this, the increased vaccine supply, the therapeutic treatments, etc. Most governments are now starting to ease lockdowns, which would ordinarily allow more economic development, a recovery into this post-pandemic world, because we're actually in this post-pandemic situation at the moment. But, in there you can see inflation, you can see volatility, money supply drying up, the cheap money that was handed out by central banks around the world. And most recently, which is probably dominating more and more the headlines, the social media, the news reports, is the geopolitical issue that has arisen in Eastern Europe between Russia and effectively the West through the proxy of the Ukraine. And that's a risk of war. It's not something that the markets haven't dealt with before. Obviously, they've been through this countless times, and we can go back and see how markets do behave. But it's something that in the last 2 years, we were in a very strange space. 2020, nobody had dealt with a COVID, so this pandemic that ravaged the world, and the sort of rubber band response and recovery thereafter, led by tech and a very narrow market. And generally speaking, the problem that we face now are issues that we didn't have for the last 2 years. We didn't have inflation, in 2019, 2020, 2021. We didn't have interest rates, the threat of interest rates, because money was cheap. It was being flooded into the market. we didn't have this threat of war. This is a bit of a left field that's come out of sort of nowhere, seemingly. But certainly this is more of a, without the war issue, the potential of war, this is more of a normalized economic environment of overheating economies, rising interest rates, inflation, using interest rates to counter inflation. This is more normal. What we had in the last 2 years was very sort of, was very unusual. And we're sort of now going back to more fundamentals of companies that should be looked at in terms of, let's say, their great balance sheets, their earnings. Earnings is always key in analyzing a company, analyzing an investment, putting it into your portfolio or a basket and a note, etc. Making sure that the earnings are really, really great. Now, this threat of war, and I'll just deal with it now before we move on. It's certainly casting a major shadow across the world. In as much as it's an Eastern European potential conflict, so a regional conflict, it has global reach in terms of it's going to affect, the entire world. The Ukraine as an area is very, very and highly rich in resources, in agriculture, food supply, and energy. And I think, in fact, I was reading a report on Reuters just before we came on that Germany has now pulled the plug on the gas pipe that was going to be supplying Germany, a lot of Germany, with its energy supplies from Russia, the Nord Stream pipe. It's been very, very difficult because this is a conflict where war is being used as an economic lever in terms of how the parties are all behaving. Germany, for example, was a little bit ambivalent in terms of how it responded to these massive troop buildup because it had an economic interest to keep the gas flowing. The West has responded fairly slowly, and there's clearly no indication that they're going to be committing, forces in any size to this conflict. It's not going to be another Afghanistan. They're talking about various packages of economic sanctions and other sort of slap on the wrists. So it's a dangerous precedent from my perspective in terms of it happened in the Crimea when Russia sort of annexed the Crimea. This could be another situation of reclaiming what they think is the old part of the old USSR. And it leaves a dangerous precedent for the world, in fact, if one thinks about it. I love history. I'm a student of history. And if I look 2 weeks ago, the Chinese premier visited Russia. I'm not a political conspiracy theorist, but I wonder if the same thoughts are going through the Chinese premier and their leadership team saying, maybe the West won't touch us if we take Taiwan. So, yeah, it's a dangerous precedent. But, we need to sit and watch. I believe there have been some incursions into Ukraine in terms of so-called independent areas that wanted to be declared independent, and Russia is going to help them. So that might be their key in. It feels as though it's going to happen. I mean, I feel there seems to be this daily rising tide that at a point in time, it is going to happen. I hope it doesn't, because generally conflict causes huge uncertainty in markets. To come back to that FUD acronym, fear, unease, and doubt. It's something the markets don't like. Markets hate uncertainty. If a war does start, if it does come to bear, they know how to behave. At the moment, markets have been characterized by an almost pinball type of relationship. We've really seen, I'm sorry, I'm just going to plug my battery in. It's operator error there. The markets have been characterized by a January and a February where there have been enormous swings in how the markets have behaved. I've actually done a rationale, which is available, and it certainly takes away the key points of what, looking back in the rearview mirror, if you want to call it that, how has the first part of 2022, the first month and a half of 22, behaved? And it's behaved in quite frankly, in a shocking manner, because January normally historically has been quite a good month for markets, for investments. Sometimes we get what's called the Santa Claus effect, which is a sort of a delayed, not hangover, but it's a delayed momentum shift from December, and it's positive and it's good vibes, and off we go. And in the old stockbroking parlance, many stockbrokers regard the first 4 or 5 months of the year as great months to make money and sell in May and go away. 2022 has turned that completely on its head. We've seen massive value destruction right across most demographic areas, geographic areas, market areas, asset classes. Nothing really has been spared. And it's certainly been quite a challenging time. I'll just give you, and then we'll move on. The S&P had its worst January since 2009. The NASDAQ was down 9%, and the Dow Jones Industrial, the DJ, had its worst January since 2016. 9 of 11 sectors in the Standard & Poor's 500, that's the 500 largest companies registered on that market in the US. 9 out of the 11 sectors were negative in January. So, the 2 positive ones were energy and financial, and we concentrated on those. We had a look at those to see that was a pointer in the right direction. Lastly, the small cap company index, known as the Russell 2000, 2,000 smaller companies, mid-capitalized companies, which is perhaps a better generator of what middle America is doing, fell 9.7, the worst January decline since 2009. So it's been a torrid time, and it hasn't been contained to small companies or medium companies. It's hit everybody. I was watching a week or so ago, the fortunes of Facebook. Facebook is now known as Meta. It's reinvented its name as Meta, M-E-T-A. And it made an incredible $113 billion last year. $113 billion. Think about that. That's a lot of money from activities and advertising and revenues. And yet the stock has been trading like a small biotech sort of startup firm that has just announced a phase 3 trial failure. Except in this instance, its market cap dropped by a cool $250 billion. Now, a small startup company wouldn't survive. It would just simply go out of business. Facebook has got the particular balance sheet to obviously absorb that loss, but $250 billion in 2 or 3 days. So even the mega cap trillion-dollar companies have been really, really ravaged. It's been a trying and a testing time. And it brings me back to the concept of structured notes, where we look to find what is going to do well in an area that is going to be under siege. So we go back to, if you look at this chart, what is this? I mentioned that the 2 sectors that were positive have been energy and financial sectors. Certainly energy will be a sector that could very well profit out of a war in the Ukraine, given it's such an energy-rich country. But look at this chart. It goes back a while, and it's up to current. It's an indication of the Dow Jones banking sector index. Nothing ever works in a straight line. Nothing is ever linear. In other words, A to B, there's always going to be bumps along the roads, dips and troughs and peaks. But generally speaking, the dips and troughs here aren't exaggerated, like a 30% fall in a Facebook share, et cetera, et cetera. There's a steady inclination in terms of that line that you follow upwards. And that tells you something a little bit about the banking sector, the financial services, but mainly not financial services per se, wider, which will encompass all sorts of different financial entities. I'm thinking more about banks. So the previous slide, we spoke about inflation, interest rates, the shortage of money, the money supply is drying up from central governments now as they ease from the pandemic. Banks profit from this. And I spoke to Kim earlier, and we produced, this will be our 5th banking note in the space of just over 14 months. So Cashbox was very early into the recovery of the broader market, which started effectively, late part of 2020. I mentioned this, I call it the rubber band effect. We came shooting out of the blocks around about March, April of 2020, with tech driving the recovery, the digitization, the work from home analysis, those work from home darling companies that took us through the pandemic. but a lot of great companies were left behind. Now, banks are typically known as defensive stocks. You don't buy them for growth. You buy them because they're going to give you a pretty good dividend, pretty solid dividend. They're reliable. And they actually have this interesting relationship when interest rates go up. Those are their customers and clients who are carrying debt, obviously pay more, and they create better revenues. So herein lies the trick. In 2020, the banks didn't know where the pandemic was going to go, where it was going to end, how deep it was going to go, would it create a recession, would it create a complete economic financial reset and collapse. It didn't happen, but they made massive provisions, and rightly so, for their clients, for themselves, for their own balance sheets, to make sure that their company would survive. Many of them stopped distributing dividends, simply to protect the profit and loss balance sheet and their staff and shareholders and clients. I think what happened is that there wasn't because there was no scientific data to model on, they made these massive over provisions. And as we came out of the pandemic, and as the different variants manifested themselves, and apparently weaker in terms of their danger, banks decided, well, we don't need to make these provisions stay on the balance sheet. We can start reintroducing them back into our balance sheet. Now, that comes through as profits now, because on their balance sheet, it would have been in brackets as an unrealized loss because they can't use it. And now it's being filtered back into their balance sheet. So banks during 2021 had a stonking run. We were early into that space by saying interest rates are going to change. There was already, there were already rumors and suggestions way back in February, March this time last year, that interest rates were going to move. It's taken a while to get there. But we got in early, and four notes that we've produced. This is the fifth. The last one, actually AutoCall last night. So none of them really lasted more than 6 to 12 months because we were coming off such a low base. And as these big provisions came back into profits, obviously it boosted the prices. Now, what's going to happen is with interest rates rising, because we didn't see this in 21, this is now happening in 22. This is going to be a different revenue stream for banks. This is going to be profits. Okay, this is going to be revenues. They're charging their clients, different base rates in terms of their debt and how they're doing it. So a great story. We've got the empirical evidence that these work very, very well. We've chosen different banks this time. In fact, we have one bank that we have used consistently through this period in all our notes, and that's Banco Santander, a Spanish multinational. But there you'll see Commerzbank, you'll see a large Italian bank, and you'll see pretty much a household name on the right-hand side. But it is global. So we have 3 European banks, German, Spanish, and Italian, and an American bank. That's a little bit of their size, their nature. You can see the big boy in that crowd is the Goldman Sachs team, the Goldman Sachs Bank, in terms of its market capitalization. I think what's important is that, and I have mentioned this, and forgive me because I do bang on about it, Cashbox and IDAD as well, we'd like to secure companies, solid companies into the notes which are well researched, that meet the right criteria, and that certainly have the right gravitas in terms of size. So now if you look at, Commerzbank, the Italian bank, that's first and second. The Italian bank is the largest bank in Italy. These are big names in Europe. Outside of Europe and South Africa, we may not have heard of them, but these are very, very large international banks. These are banks that are pretty much tier 1 rated in terms of being investment banks. They can issue debt off their balance sheets. They tick all the boxes. So we're not going to throw in a wild card here from a bank in Lithuania or from Greece or from Iceland. These are pretty much big, solid. They're part of the fabric of each of those countries.
Andrew, if I may, could I just jump in there?
Certainly, jump in.
Just to, as Andrew's absolutely spot on with his analysis of these banks, but I think really just to add a little bit of color to what Andrew's mentioned there. For example, if we pick Commerzbank is one of the key banks that works with what they call in Germany the Mittelstand, which is effectively the core backbone of the manufacturing base of Germany. So Commerzbank is the sort of bank that you will go along to as a middle tier manufacturing owner, and you'll go to the Commerzbank to look at your cash flow, to look at debt, to look at the whole financing proposition of your business. And the Mittelstand of Germany is huge. It is vast. It is how Germany ticks. It's not just a handful of businesses that allowed Germany to become so powerful, as in BMW, VW, whichever name you might pick. The Mittelstand is the backbone of German manufacturing, which is supported by one of the key banks, as in Commerzbank. So, quite frankly, as Andrew's mentioned, these organizations are huge and critically important to their geography, where they sit in Europe. And so therefore it really does underpin exactly what Andrew was saying. We absolutely analyze to the nth degree to make sure that the baskets that we pick are baskets that will succeed, and performance demonstrates that time and time again.
Yeah, thanks, Graham. Yeah, it was super insightful. So that's the mix that we've included. This takes us a little bit into the actual key metrics of the actual product. The issuing bank is another Spanish multinational, BBVA. It's probably just outside of the top 10. I think it's about 13th, 14th largest investment bank in the world. Very, very active in structured notes, very, very successful, great credit ratings itself. That is absolutely critical, is who is the party who's actually underwriting this deal, because this is a deal with defined returns. It's contractually underwritten by the bank. They have to pass muster in terms of their own internal requirements as well as their regulators. So it's important that we deal with the right bank to issue the product, not just what we include in the basket. So it's an overall composite presentation. We've mentioned that it's we've got a fixed return of 2.5%, and it's the difference. One of the differences of our normal product is that you'll see a 60% initial level trigger for the income, and also if you go a little bit further down, if you follow the little red cursor, 60% of the capital protection. So I'll just read, there are a couple of people on the call that might not be aware of this. We normally try for what's called a 50-50. So those percentages would be 50 and 50. In other words, a 50 would mean a slightly deeper level of opportunity for the client. In other words, on the income level, you'd be allowed 50% degradation. As long as that didn't go below 50, then we would trigger the income, and the same goes now for 60. The bank itself, underwrites these terms, and we still feel very confident that even at 60% of initial level and 60% maturity protection, those are great and deep levels. It's a good income trigger, and it's a good maturity trigger. So we are not concerned at all about that. The banks, the actual constituents of the basket, we've run through. The AutoCall trigger, which is the early maturity feature, and we'll run through it in a chart shortly, is 100% of initial value. So we'll have a start date, and from 12 months, okay, so quarterly, as long as the terms and conditions are met in terms of the 60%, the line above it, the income will be paid. But as long as at 12 months and quarterly thereafter, they're above their starting prices, an early maturity feature triggers by the bank. The bank recalls the product, pays the full capital back, and with obviously the last coupon. So I suppose the worst case scenario from an income perspective is that this product outperforms its starting prices as at 12 months. So you'd have picked up 4 coupons and the product ends. That's what we saw last night. After 6 months, that particular AutoCall was 6 months, and after 6 months, all those shares had risen. And if we look at the forecast, is that with those inflationary issues, with those interest rate issues, revenues of banks is going to go up. So we would like to think, I think the bank would like to think, that this is going to end at 12 months, because the bank actually doesn't want to keep paying these high levels of the cost of capital that is having to pay. They want the money in, they're having to pay for it, but they'd certainly like it. So they're quite happy to call it at 12 months, subject to the T's and C's. We've got a, with a structured note, it's a closed-ended, as you all know, it's a closed-ended product. By that, what I mean is that it's open for a subscription period. And it also, we have an amount, an inventory amount. In other words, the bank will underwrite a tranche, whether it be 500,000, $1 million, etc. So whichever comes first, whether we, exhaust the inventory early, or if the 8th of March comes, that's the final cutoff date. So anybody who arrives on the 9th and there's still inventory, it's too late, it's closed. Minimum entry is $10,000. It's only US dollars, and it's a 4-year term, so it's fairly short if it had to run all the way to maturity. We'll go through a slide which takes you through it in a little bit more detail. This is the fact sheet that you're becoming more and more accustomed to. It's the salient features, trigger dates, which are important. The central column, we've pretty much run through those in the previous slide. The slide on the right, those are your sort of those are the sort of key information dates. So it's running, 14th of Feb. We breathe it into life. It's a week old. The strike date, in other words, where we benchmark the prices of those underlying shares, is on the 11th of March. That's critical because those become the observation numbers that we need to look at on the observation dates, which we'll look at in the next slide. It actually gets going. Issue date is start date. In other words, for start date, 18th of March. But we need to have pretty much deals cleared, funds accepted by latest the 10th of March.
By the 8th, Andrew.
Oh, the 8th. Okay, I'm just reading off 10th, but 8th from the previous slide, correct. The other date, the first coupon observation, so the first 2.5% will be looked at on the 13th of June. That's 3 months hence. Payment date's a week later, and the first order call is the year from today. That's 2023. I think if we go to the following slide, you'll see the actual observation dates. Yep, there you go. So that's pretty much your set in stone, contractually defined dates where the observations will be taken. The payment is normally a week later, that the column alongside it. There, your income triggers, as long as the prices are all 60% of those 4 shares at its observation date, it will pay the 2.5%. It has a memory feature, and we'll bring that up. But if any one of those is missed, you don't lose the coupon. It's withheld. And at the next successful observation, that coupon plus the observation coupon will be paid. So it's a bit of a snowballing coupon that you don't lose, but you can make it up at a later observation date. Very nice feature that we pretty much demand when we build this in. We don't want a hit and a miss and you got no second chance at it. There should always be that chance to make up lost coupons. And finally, on the right-hand side, you can see for the first 3 observations, it's not applicable as an order call feature because it only kicks in from 12 months from the 4th observation and thereafter quarterly. So it's as it runs through its timeline, through its longevity, every quarter is potentially, after 12 months, is a potentially a liquidity event for the entire investment. So typically this is something we build into our notes. Moving on, Jill, if you don't mind.
Should I run through the...
Yeah, you can run through this. Change your face.
Okay, so for those of you that don't know how the income works, I said we do have some new people on the call. There are things that we look at and we build in so that we can, make it so that you can plan on your income coming through and know exactly what's going to be happening. So the first thing that we look at is the start value, and that is measured on the strike date. And that continues all the way through, and that is at 100%. There is a protection barrier. In this case, it's actually 60%, not 50%, where as long as the 4 underlyings remain within this range or above, income will pay out at each quarter. In the event of it dropping below, so for example, over here, if it drops below that 60% level, the income doesn't pay that particular coupon, but it looks back. It holds it for the next observation. So in this example, Q4, it went back over the 60% mark. And at that point, it'll pay out the coupon that's due, plus look back and pay any missed coupons. The other level that we always look at is the AutoCall, which in this case is also set at 100%. So after the 4th quarter, or from the fourth quarter. As long as the underlyings breach that 100% mark, the product will mature early in AutoCall, and then you'll have received all your coupons up to that point and receive your capital back. In the event that the product does run the full term, which essentially they're not designed to run the full term, what will happen is at the very, very last quarter, they will look at the underlyings, and as long as the underlyings are at least 60% of their start value, you will receive all of your capital back as well as having received all of those coupons. And for the past 5 years, 100% of these notes have auto-called exactly as designed. So they haven't run through the full term. And then just to go back into the regulated environment, each contract vetted by each party. Again, you have Cashbox and RDAD. You guys all saw Graham just now. They put the notes together. We regulated in Mauritius, RDAD in the UK. Your investment platform is regulated as well. For those of you who have never invested in a note before, you do require an investment platform, but we can run through that with you separately. And then obviously the investment bank, the issuing bank, that is regulated. Then just in terms of next steps, any questions? You guys have been very quiet. Mm-hmm. You all know that Graham likes life from Stone now. But I don't see any questions from anybody.
If I could just jump in just quickly. I was talking to a client this morning about this particular product, and they asked me, they said, where would it fit in my portfolio of notes? Because this particular client he actually had a banking note that matured and didn't reinvest. He actually had the funds allocated for a business which subsequently hasn't eventuated, so he's reinvesting. But I said to him, certainly in terms of, the shape and the design of this product is more defensive. Hence the banks are, they're not falling over themselves and offering 14 or 16%. They know these banks are solid performers, and over time they will increase in value. So there's a high probability, there's a high chance that at 12 months, this could end like all the other banking stocks have ended. It's a bit of a, if I can call it without being disingenuous or cheeky, it's a bit of a steady Eddie. These are sort of Titan type companies, very large household name companies in the banking world. And they sort of not plod along, but they certainly don't have the pinball type of reaction that you expect and you see in some of the other sort of more sexy, fizzy sectors. So that's hence, why is the coupon low, and hence the explanation. Yeah. But in terms of fitting into a portfolio, I like to think this is almost like a base layer on a cake. Sometimes when you look at a cake, how it's iced, all the exciting stuff is on the outside, all the exciting fondant and creams and icing and decorations on the outside, but you have to have something solid for it to sit on as a structure, as a platform. It's a little bit like building a house. You need to get the foundations right before you build the walls and start buying your big screen TV and your sofa. And if you build your house properly. So this is I certainly believe this is a great product in terms of fitting into that space of creating a good base. Solid defined returns. It's certainly very different to another product we're working on. And I'll just give you a little bit of a flair for it because I think it's fair, because you will be invited to that webinar. And the two almost are running concurrently. Graham was instrumental in sort of bringing these to life, breathing life into them almost simultaneously. And the second one is very, very different. So it will probably be about, certainly probably next week, later this week, early next week, we'll do the webinar on this next product. The next product is a very different. It's also an income, US income. It's issued by a very large French bank, BNP Paribas, but it's designed very differently. It's designed for a fizzy sort of coupon. And that coupon is actually very high. It's sort of 17% per annum. So it works out to just over 4% a quarter. It's got slightly different barriers and protection levels, and there's always a payoff. If you want something really sexy and out there with a high rate of return, you've got to pay for it somewhere. and that comes off in the sort of protection levels and barrier levels and coupon levels. But it's a fantastic product also. It's premised on a lot of time and effort that went into the underlying basket in terms of those companies. And they also, all three, there's only three shares in it, all three major household names. So it's an exciting, very exciting proposition. It was actually, if I can just digress, it was actually designed to comply with a particular investor who wanted it to be Sharia compliant, in other words, compliant with the cultural and clerical laws of his religion. He's based in Dubai, and the Sharia law is very strict in terms of what companies can go into underlying investments, etc., in terms of the makeup of those, how those companies derive their profits and their earnings. So we were delighted. It's quite a feat, I think, to be able to say that this particular product has received the acknowledgement. It's been through the vetting process. BNP Paribas has been through the vetting process, and it's received its Sharia certificate. So that's something that just simply doesn't eventuate every day. Obviously, we have a very delighted client in Dubai. We've hedged $1.5 million, and certainly it has got a very fizzy appetite. But I would say to clients, it's not all about the return. It's also about, if you go back to that first slide, it's about what's happening in the world at the moment. Volatility, steadiness, which is not there at the moment. There's unease, there's doubt, there's that wall of worry. The bank's note that we're talking about certainly has got definitely a peg in a round hole scenario for many portfolios. I don't know if you want to add a little bit on that, Graham, because I know you were intrinsically involved in obtaining the certificate.
No, absolutely. I will touch upon your what you've mentioned there, Andrew, with regards to the Sharia compliant note, and that is, I know this webinar isn't about that, and you're going to host another one. I'll be delighted to join that. But certainly, it's received its its ATWA certification, so it's fully Sharia compliant. But the beauty of these notes and the beauty of what we do is that we do not preclude other investors. So it's not a question of, and quite frankly, it's not a question of you following Muslim religion to be able to invest in this note. It is available to a very, very wide audience. It's just that it is Sharia compliant, which means that as a Muslim investor, you are able to invest in this product and satisfactorily know that if a cleric was to challenge you, then you could prove that it was Sharia compliant. But going back to Andrew's point with regards the note in question here, I think he's raised a very, very valid point in the sense of the idea of this being a backbone to your portfolio, to your investment portfolio. I had a very, very good discussion with a discretionary fund manager only last week on the Isle of Man. And normally these guys would dismiss somebody like IDAD because they say, well, do you know what? We know what we're doing. We understand the stock market. We're more than happy to carry on doing and pursuing our expertise. We don't need you. The discussion I had actually evidenced the fact that discretionary fund managers now, and the likes of pension trustees and all these other professionals within the wealth management arena, which Andrew has touched upon, actually do require a sense of capital preservation. Now, a discretionary fund manager will look at a structured note that we have with this global banks, and they will say, okay, so you can tell me that you will provide a 10% per annum coupon on these 4 stocks, and at the same time, give me a 40% protection against a capital depreciation of any one of those stocks, worst performing. And that's when the discretionary fund manager thinks, okay, so I've got a 10% return, not guaranteed, absolutely not guaranteed, but my word, what a depth of capital preservation that you have with that type of note, to then be able to sit that in the portfolio and know that then your own expertise as a discretionary fund manager, you can chase alpha. Now, as Andrew mentioned, this Sharia compliant note is a 17% coupon. Some discretionary fund managers are chasing alpha at 22, 23%, even higher. But there is an element of risk that goes with that. And, you know, as I say, it really confirms what Andrew's saying. To have a 10% returning investment per annum in your portfolio, I think is very, very powerful. And, you know, with the basket that we've elected between ourselves, with the thought processes of Cashbox and IDAD, we are extremely comfortable that on the basis of our income trigger and our capital preservation barrier level, we have a note which is absolutely the backbone of any investment portfolio. So it's great to see. Andrew's absolutely right. It's the fifth one in the Cashbox stable. It's incredibly well track recorded. You know, the performance is there to see. You know, you can look at these individual stocks. You can see that as a strike date of the 11th of March, you know, looking at certainly at past history performance, you can just identify the fact that the idea of breaching a 60% capital preservation barrier is really pretty much out of the question. I mean, we've got to have a major disaster in the world, quite frankly, for any one of these four substantial businesses to suffer a capital depreciation of that level. So incredibly powerful, incredibly solid, and I absolutely concur with Andrew. Steady Eddie, you know, just ticks along. Thank you very much. 2.5% per quarter, 10% per annum. Great.
Yeah, thanks, Graham. Highly concur. Are there any questions?
Yeah.
There seems to be quite a few come through there, Jill.
What jurisdiction does it fall in for death tax purposes from Sue?
Okay, so it's UK. So it's a UK promoted product, and but as far as death duties are concerned, it's an international structured note. So it's for jurisdictional purposes. It's entirely dependent on your estate, and Andrew knows far more about this than I do. But it's really a question of your own residency and your own citizenship status, etc.
Yeah, so in as much as it's an international investment, it ultimately would fall part of your international tax residency. So if you, let's say, for example, tax resident and your jurisdiction is South Africa, ultimately it's reportable on your South African balance sheet to the authorities at that point in time. There's no general withholding taxes by the jurisdiction, as Graham said. So we've chosen very carefully. We don't want to have it in a jurisdiction where that particular government will start deducting withholding death taxes. So simply put, it's pretty much, as Graham said, it's part of your residency where you live in the world for your tax purposes, tax returns.
Right. Thank you. Any other questions from anyone? Sure, you obviously did a good job. Okay. So with that, I think we'll close off. Look out in your inboxes. I will be sending through the invite for the next webinar on the other product. So we'll probably see that next week. And then again, if you've got any questions, just drop me an email, or you can email on support@cashbox.global and we can work that through. And then if you are interested in going into this product, again, let us know. We'll send you the ISA number and any other information that you would like. And with that, thank you, Graham, for joining us as usual. Thank you, everybody.
Absolute pleasure.
And
thanks, guys.
Again.
Perfect.
Thank you very much.
Cheers, everybody.
Take care. All the best from the UK. Cheers now.
Thanks.
Bye-bye. Bye-bye.